Yet another announcement regarding job cuts. Kraft Heinz, that newly merged company, is laying off 2,500 workers in the U.S. and here in Canada as part of plans to cut costs after the merger. Now, 700 of the job cuts are taking place at the company's head office in Illinois, though Kraft Heinz wouldn't specify exactly how many are taking place here in Canada. It did specify, though, that all the jobs being eliminated are salaried positions, and it said none of the jobs involved are factory workers. The job cuts, though, are not surprising. This merger between the two food giants was orchestrated by Warren Buffett's Berkshire Hathaway and a Brazilian firm called 3G Capital. These are the guys that bought Tim Hortons, and they're known for this type of cost cutting. They're known for acquiring companies and then eliminating positions like this, cutting the fat wherever they can find it. So it's not surprising that we are seeing layoffs. The company also reporting some weaker than expected earnings just the other day. Most all of the cuts expected to be on the Kraft side. All right, meantime, another tough one for markets today. We saw Toronto stocks sell off. Global markets, all of them were down quite significantly as China, for a second day, devalued its currency. The Chinese central bank allowing the yuan to drop another 1.9% against the U.S. dollar. It's at a 4-year low. What they're trying to do here is devalue their currency to make their goods that they're selling look more attractive. They're going to be cheaper. The opposite, though, true for any companies selling to China, like Apple, who's seen its stock drop sharply. Their goods will appear more expensive to a Chinese buyer. So that's one of the reasons we're seeing stocks fall. Another reason is investors are wondering now just how badly economically are things going in China that the central bank feels the need to do this for a second day. Are things much worse than what the official economic statistics suggest? That's the question. Again, Bay Street under quite a bit of pressure today. Air Canada, though, in with better than expected earnings. The company turning a nice profit in the second quarter. Profit up 33% year on year. And the airline on track now for a profitable year, it says. What it's been doing is cutting costs. It's also benefited a lot from the lower price of oil, and that seems like it's going to stick around a while. A weakening Canadian dollar typically hurts the airlines, though Air Canada said it fared quite well with the weak loonie in the latest quarter. Finally, some booze news for you. Beer sales have been flat for a while, but another fizzy drink is filling up drinkers' glasses. Sparkling wine sales are surging, not champagne specifically. We're talking about things like Prosecco. Prosecco sales up 30% annually last year. Millennials are turning to sparkling wine, and it's not just a special occasion thing anymore. It's appearing on dinner tables, and it's appearing on brunch tables. We know millennials love brunches. Prosecco often paired with orange juice there. So sparkling wine sales soaring as beer sales trail off here in North America.